Dre Parker back with you, and you may have watched The Power of Leverage 1, 2, and 3, and you may be saying, this is some good stuff. I just need a little bit more as far as the explanation of how this could work for me. You know, this reverse banking method is not for everyone. There are people who use IBC concepts and use their own money, or they create this infinite banking concept and use their own money. This is totally different. This is for people who would like to use leverage to build wealth. So let's talk about what you see on your screen right now is your financial pyramid. See, a strong financial pyramid is important. Just imagine not having the proper foundation for your finances. Your financial world will actually start crumbling down. So as you can see at the bottom of the pyramid, you need a certain amount of conservative investments. That's where your FDIC insured checking and savings accounts at, your treasury bills, your notes, your bonds, life insurance based products, US savings bonds, FDIC insured CDs. As you notice, as you move up the pyramid, there's a little bit more risk. Then you get to your high grade municipal bonds, your money market accounts, your high grade corporate bonds, your balanced mutual funds. Now you're starting to get into securities with preferred stock, convertible securities, high grade common stocks, growth mutual funds, limited partnerships, real estate options, speculative stocks, gold, silver, collectibles, futures, commodities. And at the top of the pyramid is your venture capitalists. Now, see, if you decide to say, hey, I'm not going to build a good foundation, I'm going to start at the top. If you flip this over, your financial world will actually topple down if you start at the top and move your way to the bottom. So even venture capitalists know that with all the risk that they take in investing in businesses and get businesses going, they still have to have a solid foundation, because the solid foundation, yes, it may seem boring. However, look at your house for an example. If you had a clean slab that's strong and secure for your foundation, you can build a huge house on it without worrying about the foundation coming tumbling down. You have to do the same thing when it comes to your finances. So, as you can see, it's important that you build the base of the pyramid with these types of investments. Well, let's take a look at this chart. And this is conservative assets, the bottom base of the pyramid after tax returns. Now, looking at the chart, where would you want to put your money at? What makes the most sense? Of course, most people will say, well, hey, if I'm getting an average conservative after-tax return of 6% in life insurance products, that's probably going to be my best bet. And why would you pick life insurance? It's just as safe as these investments, but it's a tier 1 investment. So the average return, you're looking at 6%. When you add leverage to life insurance, it's a totally different game. I want you to think about physics. If I use leverage, I can lift something up a lot more easier. Well, it's the same thing when it comes to leverage in these particular policies, which I'm going to go over. Using other people's money to grow your returns, you end up going from 6% to somewhere on average of 12%. Now, you might say, hey, you know what? I love these products. I'm going to just use my own money. I'm not going to use other people's money. I'm not going to use the leverage strategy to increase my rate of returns. And that's fine. You can actually do that. But these products, back tested, has averaged near the 12% after-tax returns using the power of leverage. Here's a diagram of how it actually works. Now, here's your money. You can see the pile of money right there that you're going to pay in premiums, right? We take this money, we apply it to a life insurance policy. Now, this policy is going to build cash value. It can build conservative-like returns with whole life or aggressive-like returns while still being protected through indexing strategy with index funds. See, with this strategy, you have to use your own money for 2 years before you can actually use your cash value as collateral. So as you can see, the cash value grows. This is 2 years of your money. Now you can go to the banks or private equity firms, the firms that we use to actually use and leverage this strategy. You could go to them and say, hey, I have a certain amount of cash value in my policy and I would like to use it as collateral. And this is what the banks call a cash value line of credit. So what is a cash value line of credit? All it is the banks or private equity firms, in this case, giving you money while using your cash value life insurance policy as collateral, which allows them to actually be protected. See, they look at this as hard money loans. I'm going to lend you $40,000 because you have $60,000 in cash value and you have a $500,000 death benefit. So they feel super secure because it's creditor protected, because it's in life insurance. It's protected against taxes, so Uncle Sam can't touch it. And it also has a legacy strategy, which is if this person dies, I could collect my money from the death benefit. So they know that this is super secure. See, even in real estate, if it depreciates, it can actually go down. So the good thing about private equity firms using this is because they know that it's a super win for them. Now, what do you do with the money? What you're going to do, as you can see how the chart goes, you borrow the money from the private equity firm and forget about the bottom for right now. You actually continue the cycle and recycle this into the same system where you're borrowing from maybe 2 to 3%. And yes, those are actual real numbers when it comes to borrowing from private equity firms, 2 to 3%. And in these policies, you're making 6, 7, 8%. So why not continue to use that cycle? That's called positive arbitrage. And you do this long enough for like a 15-year period. You keep the cycle going on, keep the cycle going on. 2 years of your money, 13 years of their money. So eventually, you're going to continue to borrow from the bank or from the private equity firm to continue to make premium payments. But you have a surplus, and that's going to be the key. You have a surplus, and you can actually take that surplus and invest it into other investments, or you can use it as income. Let me give you an example of how this will work with even a 59-year-old. So let's take a look. So as you can see over here, you have the age of the person, 59, and you have the year 1. And what you see right here is premium payment of $100,000. Over here, you have the net cash flow of $100,000. You do this for 2 years. So you can see whatever's in parentheses is your money. That's what you're contributing to the policy and premium payments. Now over here, you're probably saying, well, hey, I put in 100,000, I got 86,000. You got to remember, it's going to take a minute for you to actually get your money back. But what you get in return is the cost of insurance. That's what makes these things so sexy, is because we're building leverage and using leverage to build wealth. And at the same time, it has a legacy component. So this is a $1.2 million death benefit for a 59-year-old. So as you can see how this would work is year 3, you're done with your money. You're going to the private equity firm. You're saying, hey, I have $172,000 in here. I want to borrow $100,000. So you're borrowing this at 3%. And they're going to say, okay, of course, you got a 1.2 million death benefit, right? You have $172,000 cash surrender value. Of course, we're going to lend this money. In this scenario, because every case is designed differently. When we meet with people, we find out what the long-term, short-term, and long-term objective is so we can actually design these for what the client is looking to do with the money. So as you can see, we've done this for 12 years. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 years of using this strategy. And I need you to know this account value is actually net. It is net. And I want you to understand why this is important. Let's say the private equity firm wants to call the loan on the 10th year. So let's take a look. On the 10th year, you put in 1, 2, 3, 4, 5, 6, 7, $800,000. You have to realize this is net. So you give them back their money and you still have $515,000 of cash value. But here's the beautiful thing long term. You're paying 3%. These policies have averaged well over 10 to 12% using this leverage strategy. I need you to understand why this is important and why the wealth of America love these strategies. Because if they call the loan, right, you have that. But what happens, like hypothetically, let's say this person died at this age, at 68 years old. Well, this is net. They're leaving 1.7 million to their family and tax-free, and that's after paying the loan back. This is a powerful tool for leveraging and building wealth. If you do this long enough, so look, 15 years, you have $1.2 million, right? $1.2 million. And here's where the magic begins, right? Here's where the magic begins. You have 1.2 million in cash surrender value. And as you can see right here, you're going to go to the private equity firm and say, hey, I need to get $314,000. Of course, they're going to give it to you because you got $1.2 million. And you say, hey, what I'm going to do is I'm going to take $100,000 of that money, continue to fund this policy, right? And you take that 214, which is tax-free, because by law, you cannot be taxed on a loan. The beauty of this is you could take that 214 and use it as income, or I'll go back to the previous picture, or you can do what the wealth of America do. You can say, hey, I don't need all that income. I'm going to start to invest. Now you're taking this income right here, you see, and you're investing it into other investments, which could be real estate in this situation. So hopefully you can grasp this. Even at 59 years old, you can use this for legacy, leverage, and lifestyle. And I want you to look. You can see we're continuing to do the cycle. We're borrowing money, right? We're taking $100,000 out of whatever money we're borrowing from the private equity firm and putting it $100,000 into the policy. Look how old this person is. Let's say hypothetically, this person passed away at 82. Well, 2.6 million is going to the family. That's after the loan is paid off. And as you can see, long term, this person is 93 years old. Look at the money. Look at the death benefit. All this was done with $200,000. The wealth was built from leverage, a little bit of your money and a lot of private equity money, and strategy and discipline and knowing exactly what you're doing and what your long-term plan is. The qualifications is you got to have at least a 10 to 15 year time horizon. There's other strategies for people who want liquidity in 10 to 15 days, and that's what our IBC concepts or IBC strategies. But this is a different strategy. You have to have at least a 10 to 15 year time horizon, 10 minimum, 15 is idea. You have to obviously qualify for the insurance, and you have to meet with us once a year, because if there's a scenario where the market is doing bad, we're going to say, hey, let's put this money somewhere else. Instead of borrowing it, putting it back in the policy, which we know that zero is your hero, but you're not going to be that loyal to your policy. If we could make you money somewhere else, that way you can get positive arbitrage. If we can make you 5% in a bad economy or a bad market and you're paying 3%, the whole goal is you making money every single year. That's why the qualifications is meeting with us, mandatory to meet with us at least once a year to make sure that we keep this going and you get everything that you want out of this. If you have any questions, just reach out. We can schedule a consultation. And remember, the power of leverage to build wealth is a lot greater than using your own money. I'll talk to you soon.